This transaction marks the beginning of a series of transactions that we intend to implement for the purpose of optimizing the capital structure of EGA. So in other words, we expect to be implementing a number of other transactions in line with this one. Let me be more specific. The legacy firms of both EGA, Dubal, and Imal historically have relied on the commercial bank market and the ECAs for funding most of their capital expenditures. EGA, because of its plans to implement a lot of projects and its needs for capital, EGA has made a decision to optimize its capital structure in order to diversify its funding sources. Diversifying funding sources meaning that being able to, for the most part, accessing the capital markets and other sources. So what this transaction did, effectively, it allowed us to move about just under $5 billion worth of commercial bank debt from the operating level, at the level of Imal, all the way up to the holding company level, which is EGA. Because for optimizing the capital structure, our objective is to move about 80% of the commercial bank debt that EGA holds at the holding company level. This was the first, where we moved $5 billion, and we've got about $1.8 billion at the level of Dubal, which we intend to move, and then we've got about $1 billion at Imal, sitting still at Imal, ultimately will also be moving up to the EGA level. The Dubal transaction was implemented for the purpose of funding a new project that we're putting together. It's an alumina refinery in Abu Dhabi. The $1.8 billion partially funds that project. The balance of the funding will be coming from internally generated cash flows at EGA. Now, that financing, at the time when the decision was made to raise the $1.8 billion, it replaced a project finance plan and a facility that we intended to put in place for the alumina refinery, what we refer to the Shaheen project in Abu Dhabi. Because we decided at that time that project financing was not necessarily the best approach for funding the projects because of specific situations at the Shaheen project, we decided to raise the money at the level of Dubal. The facility at Dubal was not refinanced by the proceeds of the $4.9 billion. Like I said, the $4.9 billion was to basically take out the commercial bank debt at the level of Imal. That was the first of a series of transactions. The second transaction that we will implement, perhaps sometime next year, is to do the same thing for the $1.8 billion at the level of Dubal. So the Dubal refinancing, if you will, is the next step that we intend to implement, where we move the debt at the level of EGA. Whether we do a bank-to-bank refinancing, or whether we do a capital markets transaction, that decision has not been made yet. I think, first of all, let me just say that we were very, very happy with the outcome of this transaction. In fact, we have a number of new banks that have come in who did not have a relationship with us in the past. To just name a few, you've got ABN AMRO, you've got ING Bank, Kuwait Finance House. It's, I think, one of their first transactions outside of Kuwait. As you know, Kuwait Finance House is one of the largest Islamic institutions in Kuwait and in the region. Dubai Islamic Bank also came into the deal. In the past, we had some dealings with them, but this was a major sort of participation in a transaction for EGA. So we have a number of new participants that came into the deal. Sorry, I don't want to say participants. Some of them came at the book runner level, and some of them came at the MLA level. Now, having said that, I think what's interesting about this deal is that it was launched at a time when commodity prices were basically falling. It was launched when the liquidity market for the local UAE banks in US dollars was drying up very, very quickly. So our participation in the deal to ensure that the syndication is successfully completed was critical. And I think the underwriters will vouch for that and will explain the role that we have played. We have been at the forefront, talking to all of the banks, explaining to them the structure of the deal, explaining to them why that deal made a lot of sense for EGA. And I think, together with the underwriters, I think we were able to pull off a very, very interesting and successful transaction. This is, I think, the first, it's the largest syndication, bank syndication, in the UAE since 2008. That's number one. Number two, I just want to mention that this is, I think, I'm not familiar, there have been a lot of underwritten deals. This was a fully underwritten and fully funded transaction by the underwriters. In other words, we've closed with the underwriters first, fully funded the deal, and then later on the underwriters went and doing the syndication. So it's not just pure syndication, it's a fully underwritten syndicated loan transaction in the country. In terms of structuring aspects of the deal, I think our intention all along, now remember the backdrop of all of this, we structured this deal when the commodity prices were tanking, and we structured the deal when a lot of the local banks were hurting in terms of their liquidity. So you would think that these are the conditions that would make the banks less flexible in terms of how deals can be structured. I have to tell you that this transaction was structured in such a way that basically met all of our objectives. So let me be more specific. First of all, it was a deal with a 3-year grace period, and then it has a 7-year tenor, 3-year grace, and then there was a balloon of 30%, at the end at maturity. Now, a lot of these deals, when they're structured, a lot of the banks, they want to control the level of indebtedness, given the size of it, that EGA is able to incur over the period. Well, we have been able to structure a deal where we have carved out a lot of the ongoing deals that we're putting together from that net debt, if you will, this leverage ratio. So, for example, this deal that we're now putting together in Guinea, where we'll be raising close to $900 million, is completely exempt from this leverage ratio under the $4.9 billion deal. What's also interesting is that, when you talk about financial covenants for a transaction, you talk usually about a number of ratios and tests. In our deal, I think it's fair to say that the main financial covenant is this net debt to EBITDA that I just talked about, and there were carve-outs to that. So I think all in all, it was a deal that was structured in a very friendly way towards the needs of EGA, under conditions in the market that was extremely difficult, and we were very happy with that. And again, I think that speaks for the creditworthiness and strength of EGA and the strong relationships that we have with a lot of these institutions. What makes this transaction stand out is the following. Number one, this is by far the largest deal in the UAE since 2008. It is one of the very few deals that have been fully underwritten. It was all done at a time when the liquidity in the local market was shrinking, commodity prices were falling, and it was done in such a way that it was structure friendly towards the issuer. So taking all of these into account, we feel that was a major entry for EGA into the bank market.